How do you calculate your maximum VA loan amount? Well, in this video, I'm going to review the 5 simple steps to calculating the maximum VA loan you can get. And we'll look at the 3 considerations that the VA has that goes into that number as well. Hi, it's Rick Elmendorf, and I am a 30-year veteran in the mortgage business, specializing in VA loans. My team and I have been in the top 1% loan officers nationwide since 2003. Be sure to stay to the end where I do show you a worksheet that I wrote in Excel that shows you how to calculate your maximum VA loan amount, and I'll give you that for free. Before getting into the 5 simple steps to calculate the VA loan, I wanted to go into the considerations that the VA has. And let's start with number 1, calculating your funding fee. The VA has a basic funding fee chart. Pretty simply put is that you are charged a funding fee based on how much you are borrowing. The funding fee can increase if you are using your VA benefits for a subsequent use, they call it. However, all of this is out the window if you have a disability rating. So forget everything I just said. If you have a disability rating, there is no funding fee on your VA loan. If you are putting less than 5% down, you have to deal with the question, have you used your VA loan benefits before to buy a house? And if the answer is yes, the VA is going to charge you what's called a subsequent use fee. This fee is, as it stands right now, 3.3% of the amount of your base loan amount. We can get into the calculations, and you'll see this on a worksheet that I have for you that will be available for download. But bottom line, the subsequent use fee is quite a hammer, but the first time use is pretty docile. It's just over 2% to use your VA benefits for the first time. One thing I should mention before moving on is this funding fee is not required to be paid in cash. The VA actually allows you to finance it. So if you're doing a no money down loan and you have this funding fee that you owe the VA will actually give you the option of financing it. This results in your actual loan that you're getting from the lender being more than what you bought the house for. So you're essentially financing your VA funding fee. There is a way to mitigate the subsequent use of your funding fee and even lower the amount of your funding fee if it's a first-time use. And that's by putting at least 5% down. As you can see from the chart, if you reference this, when you put 5% down, the funding fee drops dramatically. And in the event that you are a subsequent user of your VA benefits, this is pretty important because it drops it massively. In fact, with 5% down or 10% down or more, your funding fee is the exact same whether you've used your VA loan before or not. Let's get into the second consideration called the county loan limits. Now, there are a time where the county loan limits are not in effect, and that has to do with whether or not you have full entitlement. This just means you don't have a current VA loan in place. Well, when that's the case, no matter what, you can finance whatever your lender will allow you. There is no limit to the amount of a VA loan you can get, and yes, with no money down. However, if your VA loan is already in use or if you have forfeited some of your eligibility, then there are some questions we have to determine your maximum VA loan amount. Let's look at the first question. Have you had a VA loan before? This establishes the subsequent use that I was talking about earlier. And the whole subsequent use thing is really only a matter of consequence if you are putting less than 5% down. I kind of went into this already, but otherwise, with 5% or more down payment, it doesn't matter if you've used your benefits before. Now, there's a caveat here. If you are putting 5% or more down to avoid this subsequent use fee, be careful in the event of a low appraisal. You see, the VA doesn't actually care that you're putting 5% or more down. They actually care that you are financing less than or equal to 95% of the VA appraised value. Let me give you an example. So if you're buying a $1 million property and putting 5% down, you'd be financing $950,000. The funding fee is 1.5% times $950,000. This is $14,250. Now, in the event of a lower than $1 million appraisal, let's say $980,000, let's say it comes in $20,000 low. To avoid the subsequent use fee, you would actually have to finance 95% of $980,000, which is $931,000, requiring an additional down payment of $19,000. Another question is, do you have a disability rating with the VA? Let's just say the VA is very strict about this. And let me be brief. In order to get a refund of your funding fee, the borrowers must obtain a VA disability compensation with an effective date before the loan's closing date. This is super important. Basically, we got to be able to backdate it before the date that you close, or the VA is going to keep your money. But there's been quite a number of clients that I've helped get the VA funding fee refunded. I'm going to put a link in the description that addresses how the VA looks at this effective date. But a good rule of thumb is to make sure that the VA acknowledges receipt of your disability claim at least 3 business days prior to your closing date. And this is my calculation based on guidance from the VA. Bottom line is the earlier you get your claim in, the better. The last question is, are you purchasing with a spouse, another veteran, or a non-spouse, non-veteran co-borrower? All right, let's look at these 3. With a spouse, that's easy. There's really nothing to talk about here. You can buy a home. There's no other calculation necessary. Number 2, you're buying with another veteran. The question then becomes, are you using your VA benefits, their VA benefits, or are you splitting entitlement and doing what's called a joint VA loan? These are all possible. Last question would be, are you financing with a non-spouse, non-veteran co-borrower? Now, you can use your VA loan in this circumstance. That is another video for another day, but just so you know, it can be done, and most lenders will tell you, sorry, I can't do that. They're 100% wrong. The third consideration by the VA is what's called the VA guarantee. Before we get into the calculations, we should talk about how the VA guarantee works. The VA guarantees the lender 25% of the amount that they loan. So on a $1 million loan, the guarantee in the event of default is as much as $250,000. Now I'm going to shortcut this a bit, but just remember that this 25% number of the amount financed is a reoccurring theme in the world of VA, and it has everything to do with how they calculate your maximum loan amount. Now we're going to get into the calculations, but before I do, if you find this video helpful, would you please drop me a like and subscribe to my channel? It's free and it's super helpful for the growth of this channel. Okay, here are the calculations. The first thing we're going to do is calculate the maximum entitlement. Your maximum entitlement is unlimited when you have full entitlement, and it's 25% of the county loan limit if you have charged entitlement. If you have full entitlement, in other words, there is no current VA loan in place, then there are no calculations needed. You can borrow up to 100% of whatever the lender will lend you. Otherwise, the VA is going to guarantee 25% of the county loan limit. I do have a link in the description to download this VA maximum calculator worksheet, which has all the current county loan limits. One thing to note about your maximum entitlements, they do vary by county. So as you move around the country, you're going to be in different areas, and different areas have different loan limits. And I'm talking about high cost loan limits. So there is one loan limit set across the country. That's the conforming loan limit. That typically goes up every single year. Then there are what's called high cost areas. So the high cost areas, you take the county loan limit and you multiply it by 1.5. That ends up being the high cost limit. This is what the VA goes off of if you're in one of those high cost limits. The second part of the calculation is to calculate 25% of the sales price. This is the entitlement needed to finance 100% of the home being purchased. Example, if the sales price is $650,000, then $650,000 times 25% is $162,500. The third step is to calculate your available entitlement. Again, it's unlimited with full entitlement, but otherwise it's your maximum entitlement minus your charged entitlement. Let's look at calculating your maximum entitlement. If you don't have a VA loan in use, you have infinite entitlement. However, if you have a VA loan in use, the maximum entitlement is going to be 25% of the county loan limit. And again, you can find the county loan limits in the description. So if I was getting a VA loan in 2024 in Fairfax County, Virginia, my maximum entitlement would be the county loan limit, which is 1.5 times the conforming loan limit, otherwise 1.149825. I know, it's a lot. And 25% of that number is $287,456.25. This is your maximum entitlement. Now let's calculate your charged entitlement. If you have a VA loan in use, you can find this number on your COE, your certificate of eligibility. Or you can calculate this by taking the original loan amount or amounts of the VA loans that are in use and multiplying them by 25%. You take the original loan amount, which was $400,000, you multiply that by 25%, and that would equal $100,000. of charged entitlement. The last piece is calculating your available entitlement. You just simply take your maximum entitlement minus your charged entitlement. In the example applied where I had a $400,000 loan in place, then I would have remaining available entitlement of $187,456. The next thing we're going to do is calculate the entitlement for your new loan. And we're going to choose from the lesser of the 25% of the sales price and the available entitlement that is remaining. This is the amount of entitlement you may use on the new loan. And based on the above number, this calculates to $162,500. A little pro tip here. I said may use, since depending upon your situation, in the event of an upcoming PCS, or if you think you might be moving in and holding on to this property and you want to use your VA loan again, you want to leave some entitlement. In fact, the VA requires that you have at least $1 of remaining entitlement to use your VA loan benefits again. Now, this is normally not a problem since the loan limits go up every single year, but there are some cases where I've seen people move around the country. They move from high to low, and they don't really keep this in mind. So this is something you definitely want to discuss with your loan officer and making sure that you have available entitlement. But remember, in the above example that I did, when I talked about this $162,000, you still have, if you use the full $162,500, you'd still have remaining $24,956 available. In the above example, you would still have some remaining entitlement, the difference between your available entitlement and the amount that you used. Okay, now we're at the final calculation. We're going to take the sales price, multiply that by 75%. In our $650K example, that number is $487,500. We're going to add this number to your available entitlement. This is your maximum base VA loan amount. You're going to add your funding fee to this number for your total maximum loan amount. Again, if you want to calculate your funding fee, you can look up your funding fee on the chart. I will put a link in the description, and you simply multiply that percentage by the base loan amount. Well, here we are at the end of this video, and the calculator that you have seen on the screen, I would love to get that into your hands. There's going to be a link in the description to get my free VA maximum loan amount calculator. I highly recommend it. And of course, if you ever have any questions regarding VA loans, calculating your VA loan amount, or even just discussing strategies, how you should use your VA loan on your next home purchase, I would love and be honored to have a phone call with you. Yes, you will speak directly with me. You can also leave a comment, and I do respond to those comments. And well, this was Rick Elmendorf, and thank you for joining me. I will see you on the next video.